Good morning. Welcome to today's webinar. Today, we will be talking about Trump's policies, right, on reciprocal tariff and its global impact. Before we start the meeting today, I'd like to encourage all participants to mute their microphone when the speaker is presenting. Today, I'll be speaking on behalf of Phillip Capital Malaysia and to share some of our views and investment strategies, how to navigate along the market challenges. Okay, I think everyone is very familiar with what's going on in the market right now, right? Just to summarize, right? Effective as of 9 April, right? Reciprocal tariff will be imposed by the US to more than 180 countries, right? In fact, if you look at the trading partners, right? In fact, all the trading partners have been imposed a baseline 10% tariff, right? And as I mentioned earlier, the significant higher rates will be effective on 9 April. This round, Malaysia is among the least affected ASEAN countries, with only 24% tariff being imposed, right? So how this 24% is being calculated is that the US, right? If you look at my arrow here, US has actually claimed that Malaysia is imposing 47% tariff on the US goods. So US is being kind enough, offering a 50% discount to the 47%, bringing a total tariff, reciprocal tariff to 24%. For the case of China, right? China is being claimed by the US that they are imposing 67% tariff, right, on the US goods, and US is being kind enough as well, offering a 50% discount, right? So the reciprocal tariff is 34%, right? How these 67%, 90% for the case of Vietnam are being calculated is not important to the US, right? The most important here is that we like to make this message very clear that President Trump's goal is not to bring the tariff to zero, right? Of course, in this scenario, Tengku Zafrul, right, which is our MITI minister, said that the average tariff on the US goods is only 5.6%, not 47%. But I would like to reiterate that President Trump's goal, his intention is not to bring the tariff to zero, but rather to achieve a zero trade deficit. The good news here is that, right, that this round, the reciprocal tariff exempts the critical goods under 50 USC 1702B, steel, aluminum, and auto, subject to Section 232 tariff. So these three goods have already been imposed tariff in the earlier announcement. And other exemptions include copper, pharmaceuticals, semiconductors, lumber, bullion, energy, and selected minerals that are not available in the US. So semiconductor is Malaysia's forte. So luckily, this round, these goods are not being imposed tariff, but we may not be able to rule out future possibility that eventually Trump may consider to impose tariff on these goods that we mentioned here earlier. Okay. Now, right, if you look at the tariff, reciprocal tariff being imposed by the US, right? Outside China, the Southeast Asian economies have been heavily targeted. Our analysis suggests that the higher tariffs are meant to prevent countries' circumvention and allow the US to achieve a more strategic decoupling from China under Trump 2.0, right? So what happened before what happened during Trump 1.0 is that, right, with the US-China trade tension, right, a lot of countries are actually benefiting from trade diversions, right? So Malaysia is one of the beneficiaries. Vietnam is the biggest beneficiary, right? So a lot of plants are being relocated to countries like Vietnam, right? So this round, right, with the reciprocal tariff being heavily targeted on some of the countries, right? Even Vietnam, right? ASEAN countries like Indonesia, Thailand, right? So this actually prevents China to be able to export export the goods to the countries I mentioned earlier and export to the US again. So this somehow block whatever ways that China goods can actually reach to the US customers. Right. Another key takeaway that I'd like to share with you guys is that Singapore and Australia, which run bilateral trade deficits with the US, have also not escaped from this reciprocal tariff. Right. In fact, reciprocal tariff for Singapore and Australia will be at 10% baseline tariff. South Korea and Taiwan, they are allies to the US, right? They are also being imposed tariff, and the amount, the quantum is also higher than expected. We would like to reiterate that it's very clear that President Trump's goal this round is not to bring the tariff to zero, right? But rather to achieve a zero trade deficit. We view that the US tariff announcement can open for negotiation and eases a key sentiment overhang. And we believe market focus will remain on fundamental strength and value investing, viewing any market weakness as an opportunity. We mentioned in our presentation earlier that Malaysia's semiconductor somehow, right, with the exemptions announced during April 2nd, right, that the semiconductor goods offered by Malaysia are under the exemption list, which is a very, very good news to Malaysia. But we cannot rule out, as I mentioned earlier, future tariffs and trade restrictions to the local semiconductor goods. I'd like to highlight the research done by World Bank, right, on 7 April 2025, that about 21% of US imports from Malaysia are currently exempted from the reciprocal tariff announcement, right? And this 21% of US import from Malaysia exempted from the reciprocal tariff is of higher share compared to Malaysia's regional peers, and mainly from the exemption of semiconductor imports. As I mentioned, we cannot rule out future tariff imposition on semiconductors. With the announcement of reciprocal tariff since a week ago, we see that most countries are actually trying to have an opportunity to negotiate with the US to probably lower the tariff or even remove whatever reciprocal tariff that's been announced by the US. But this time around, we understand that President Trump is a very firm guy, right? He's not going to give in, right? With that, we see a lot of countries, the likes of Vietnam, right? The likes of Korea, right? Are now flying to the US to actually negotiate some good deals for their home country, right? For the case of Vietnam, they're now proposing zero tariff, right? Zero tariff. And they're also proposing to buy some defense goods from the US to reduce the trade surplus with them, right? South Korea, right, fresh from the oven yesterday, right, they have called President Trump, right, the acting president of South Korea, and President Trump had a call yesterday, and they're now going to the US to initiate negotiations, right? Malaysia, right, today, Tengku Zafrul and his team will be heading to US for tariff discussion as well. So hopefully we'll see more and more positive news, right, from press, right? Of course, not everyone is a good gentleman, right? China is going to retaliate by imposing a 34% tariff, right? To recall, right, since Trump has been in power, he has imposed 20% tariff, right, on China. That's called fentanyl tariff, right? On Liberation Day on April 2nd, he announced a 34% tariff on China. So the total is 54%. With that, China retaliated by imposing a 34% tariff on US goods. And President Trump actually mentioned that if China is not going to give in, right, US will impose another 50% tariff, right? So that will bring out the total tariff to 104%, which is really happening right now. White House has actually confirmed that news. So China is the first one that actually retaliated. For the case of EU, right, there have been a lot of developments we see over the past 2 to 3 days, right? EU has actually proposed a 0 for 0 tariff deal on cars and industrial goods. But President Trump, right, he openly rejected EU's proposals, right? In return, right, President Trump asked EU to buy 350 billion worth of energy goods from the US, right? That can actually effectively remove the trade deficit to the US, right? But of course, unfortunately, if you look at conditions that EU is facing right now, right, they are either facing slow growth or even recession, right? Especially the biggest economy in the Eurozone, which is Germany. So with that, right, they are now proposing to hit US with 25% retaliatory tariff on some goods such as soybeans, tobacco, steel, and textiles, right? But of course, this is not final yet, right? I would like to reiterate that this is not final yet, right? This is pending the members' vote today, right? If you can look at the table itself, right? Most of the smaller countries, right, they are trying to make friends with the US, right? Either to reduce the tariff, right, and to buy more goods from the US to reduce the trade surplus. But the case for bigger markets, right, China, bigger economies like EU, right, they have more power, right? They are in the position to talk to the US, right? So we shall see what is going to happen in the next coming weeks or months. Okay. With the volatility that we see in the market right now, right, CNN Fear and Greed Index has swung to a reading of 4, which indicates extreme fear. Extreme fear. We haven't been seeing this kind of reading, right? A reading of 4, right, for a while. If not mistaken, right, we have seen that number during COVID times. Even during the Israel-Hamas war in October 2023, the reading was only 15, right? 15. So the market is now in a very, very panic situation, right? And with that, we see the global markets are in a very weak conditions right now. And even some of the sell-side brokers, they are also increasing the probability of US recession. They see higher chances of US recession this year. So our advice to our planners, right, to our beloved clients is that we need to embrace the volatility and take this opportunity to reaccess your portfolio. Your next question to us is whether the market has already bottomed. Obviously, we don't know the answer yet. With the market now seeing extremely low visibility, right, we believe that it's premature to call for a bottom. But what we can be very sure is that the valuation is now very, very cheap. In fact, all the markets that we track here are trading below the 5-year mean PE post the recent sell-off. Right? MSCI World, for example, used to be trading at more than 18 times PE, more than 1 standard deviation above the 5-year mean, and now it's trading at a discount to the 5-year mean. It's now trading at 0.8, negative 0.8 standard deviation below the 5-year mean. Asia Pac is also very cheap. Emerging markets is also very cheap. It's trading below the 5-year mean level. MSCI ASEAN, right, is even cheaper. Negative 1.4 standard deviation below 5-year mean. Among the regions that we track, we see that Korea, right, is among the cheapest, right, trading at negative 2 standard deviation below 5-year mean. Indonesia and Thailand, right, after the market reopened yesterday, right, is also trading at below mean valuation. For the case of Malaysia, we are now trading at 12.7 times PE, negative 1.1 standard deviation below the 5-year mean. So relatively, we are still attractive compared to the historical mean. And it may also indicate that the market sentiment is now very, very cautious. And probably it's also a good time to reassess whether it's a good thesis to buy into the markets that we track here. I also want to draw your attention to US market before I move to the next slide. That US market before end of last year, during the I think as of 31st December 2024, is trading at 21.6 times PE, right? And now, with the recent sell-off that we see, the valuation has also corrected. It's now trading at close to one standard deviation below the 5-year mean. So probably now, US is also a good time to look at the market, right? Okay. With that, our view is that we need to ask our investors, right, to stay defensive and focus on quality, right? For the case of Malaysia, we think that the reciprocal tariff imposed on Malaysia, though it's 24%, it's not higher than our Asia peers and ASEAN peers, right? With that, we believe that Malaysia could still benefit from the lower tariff rate compared to the peers, right? Another good news is that the US tariff announcement, right, now is open for negotiation, right? And that would also ease a key sentiment overhang. In this uncertain and volatile economic and policy landscape, we prefer companies with strong earnings visibility, particularly those that are more insulated from trade wars, domestic focused sector, and could even benefit from supply chain relocations due to the trade tensions. We believe market focus will remain on fundamental strength and value investing, viewing any market weakness as an opportunity. For those clients or those financial planners, right, that have already fully invested, probably it's also not a bad idea to adopt a switching strategy. What is a switching strategy? It means, right, today you are selling those holdings that actually drop less and move or buy the potential stocks or unit trust funds that actually drop more in the recent sell-off. So that's what we call switching strategy. Regional-wise, given the latest reciprocal tariff announcement, we anticipate that global growth may be negatively impacted, as the resulting uncertainty is likely to undermine consumer confidence and sentiment. Possible retaliatory measures from US trading partners will further exacerbate the mounting challenges. As global markets grapple with heightened uncertainty, we emphasize the importance of diversification and focus on quality amid volatility. Right? Here is the disclaimer, right? Before we open the floor to any questions, I would like to take this opportunity to thank everyone for your continual support to Phillip Capital, Management, Senyum Berhad, and Phillip Mutual Berhad. We understand that it's not a good time. It's not easy, right, to navigate along the market challenges. But we hope that whenever there's any ups and downs in the market, we from Phillip Capital, right, can offer you support, and that could be of mutual beneficial to both parties. With that, I would like to take this opportunity to thank for your support, right? And I would like to take some of the questions that you may have. You are welcome to post your questions in the chat. If you would like to unmute your mic, we are also happy to take your questions. Thank you. All right. I'd like to address the first questions from Edwin, right? Assuming China and EU go ahead with their current retaliation idea, what will be the market forecast? In bear markets like this, right, we'll see endless lower highs and lower lows, right? So it's very, very hard to assess the situation right now, right? It's very, very hard to assess the situation right now. You probably will see, all the countries are moving from globalization to protectionism, right? Just like what is happening right now. What Trump advocates is to make America great again. It's not to make the world great again. And the reason, and hence, because of that, when he's taking office, right, he tried to cut the defense spending for the Ukraine-Russian war, right? He also he's trying to assess whether it's a good idea to quit some of the world organizations like WHO and some related trade groups. So it's very, very hard to assess the situation right now, but it really depends on how the negotiation can actually kickstart. And it also depends on whether Russia, right, and US can actually work together to probably form some economic synergy. And it's very, very clear cut that probably China may not be in the picture again. Trump doesn't want to talk to China at all. Right? So ultimately, the conditions will actually be depending on EU, whether they really have some way to actually talk to Trump on better deals, right? And if EU is going to retaliate, right, like I mentioned earlier, in bear markets, we'll see endless lower highs and lower lows, and that is also becoming a very, very challenging situation to manage. I would also like to address the questions from our beloved attendee that how this tariff affects PMAT UT Flexi and PMAT Dividend Enhanced portfolio. Right. For the case of PMAT UT Flexi, conservative, our asset allocation is 25% in equities, 40+% in balance fund, and the balance is in fixed income and cash. For aggressive, the current allocation is 75% in equities, 10% in balance, and the balance is in fixed income and money market. So if you ask me whether 75% equities exposure for aggressive, is it really aggressive? The answer is no. Since last year, we have been trimming our equities exposure to 75%, from 90% to 75%. And with that, that's the reason why if you look at our portfolio, PMAT UT Flexi, since year to date, it didn't decline as much as compared to the broader markets. Yesterday, right, we did some rebalancing for all our managed UT portfolio, which includes PMAT UT, PMA UT, and PMAT UT Flexi. We are now selling some of our bonds exposure and raise cash so that we can actually capture some of the market weakness when there's opportunity. As I mentioned earlier, it's still premature to call for a bottom, but always be prepared, right? If there's any signs of positive development, right, that could actually with that high amount of cash, right, that could actually help us to position effectively in a volatile environment like this. For the case of PMAT Dividend Enhanced, right, it's a semi-quant model, right? We invest into top 130 to top 100 to top 130 market cap companies, right? And we select the top 15 dividend yielding companies based on forward dividend yield. So the reason why big market cap is very important here is that usually big market cap companies, right, they are generally more stable, they are generally more defensive in times of uncertainty, right? So for the case of PMAT Dividend Enhanced portfolio, we will still continue to employ the quant strategy that we have been employing since the day one of inception, right? We continue to monitor the portfolio. In fact, for the case of PMAT Dividend Enhanced portfolio, we have regular bi-weekly meetings to access our holdings as well. So in good times, right, just like last year, dividend enhanced model stands to benefit from capital appreciation and dividend. In bad times like now, right, the dividends that you receive from company can probably offset some of the capital losses that we might be facing. Yeah, so that is our value proposition for PMAT UT Flexi and PMAT Dividend Enhanced. Okay, I'd like to address the questions from AY. How does this reciprocal tariff affect the US dollar in the short term and long term? Okay, so for the case of reciprocal tariff, I think we should understand Trump policies as a whole. Since Trump is in the office, right, he has been pushing for a weaker dollar, right, and lower interest rate. So he has been asking Fed to cut the interest rate, right? So if we understand his policy as a whole, right, even though there could be reciprocal tariff, right, there it may also bring up the inflation, right? With like he said, right, when the energy prices and food prices recently collapsed, right, the inflation is actually very low in US perspective. So overall, I think Trump, right, he is still pushing, he's still an advocate of weaker dollar, right, and lower interest rate. The primary reason is definitely the high US debt, the high US debt. As of 28 February 2025, the US debt stands at $36 trillion, right? $36 trillion. And in fact, in 2024, if you look at the percentage allocation from US budget to the defense spending and the interest cost, the borrowing cost, you'll be surprised that the borrowing cost, the contribution is actually higher, right, than the defense spending. So it's not good. It's not good. That's the reason why he's now trying to push for weaker dollar, probably a lower yield, right, so that he can actually borrow, he can refinance his debt at a lower cost. And also the reason why he's pushing for tariff, right, is to also offset, like I mentioned, the trade surplus. And another motivation of Trump is that he's also trying to ask, the member countries to actually subscribe to the treasuries. We all know that China, EU, and Japan, since 1-2 years ago, they have been trimming their holdings in the US long-term treasuries. So now the long-term treasuries in the US are still being subscribed by the US asset managers as well as the Fed. So it's not a good idea if US debt is going to go higher and higher, right? And in future, right, the government or the country is at the risk of bankruptcy. So with that, right, so Trump is having a lot of different cards to actually play with, right? And that could also, in his opinion, to make the American great again. Can we have the slide? Of course, yeah. This will be shared with the respective channels, right? Sanjay, while we are not sure the outcome of negotiation and potential beneficiaries and who may retaliate further drag down the market, where should we position our funds, right? It's always a good strategy to adopt a defensive strategy, like I mentioned in my presentation earlier, right? Dividend strategies, income strategy, balance fund strategies. If we meet during the presentation that I presented since end of last year, right? We actually shared the top 5 teams, right, that we should be looking at this year. Our team number 3 is to focus on income and balance strategies. So balance strategies is the one that can actually help investors to cushion some downside in the market, right? And when the market recovers, equities tend to perform better than fixed income. But for now, we are also thinking that our PCM's dividend enhanced strategies could also benefit our investors. Year to date, as of 28 February 2025, we don't have the March figure yet because our fact sheets are not released. Our conventional mandate managed to register a positive 0.11% return, outperforming KLCI, which declined by 4%. Our Sharia mandate dropped by 5%, outperforming the benchmark FBM Emas Sharia that dropped by 9%. Right. Conventional this year to date, had done better than the Sharia, mainly because of our exposure in brewers, which is Heineken and Carlsberg, conventional banks like Maybank and RHB Bank, and selected REITs companies. So those are the companies that Sharia portfolio cannot buy. And that also explains the outperformance of conventional Sharia this year. Okay, another attendee asked about because the portfolio are fully invested, right? So when the portfolios are fully invested, right, as I mentioned earlier, it's not a bad idea to adopt a switching strategy. What is switching strategy? it means that we can probably sell some of the exposure that actually drop less and switch to the portfolios or unit trust funds or stocks that actually drop more. But of course, this has to be very, very selective. Ultimately, it really depends on the fundamentals, right? Whether you are still seeing some earnings visibility, right, for stocks. If it's a unit trust fund, it really depends on the timing as well as whether you're confident with the fund manager's strategy as well. Yes, Yanling rightfully pointed out that usually during market downtimes, right, clients tend to cut down investment that drop most, right? It really depends on what are the unit trust funds or stocks that you're actually holding, right? It really depends on the outlook, right? If the outlook is still quite positive, right? The fundamentals remain solid, but stock price or unit trust prices fell down. It also means that it's supposed to be an opportunity to re-enter rather than to trim down exposure. Okay, Varen asked about US tech stocks. Of course, with the recent reciprocal tariff announcement being announced, right? It's very, very crucial, right? That eventually, right, if the probability of recession is going higher and higher, right? Tech stocks, right? They may face valuation derating, right? And if the demand is actually slowing down, right, the earnings growth may also be impacted. For now, consensus are still forecasting a double-digit earnings growth for Magnificent Seven. But of course, that double-digit growth is not as high as the double-digit growth that we see last year. Last year, I think it was about 40%. This year, consensus is pricing in about 20% earnings growth. But with the recent recessionary fear, probably that will also be downgraded. So it's a double whammy for tech stocks right now, which see valuation derating and slower earnings growth. But the good news is that if you look at the US stocks as compared to other markets, right? Say Japan, say even Malaysia or Korea, right? US companies tend to have a better ROE, return on equity, right? Compared to the country, the stocks or markets from the rest of the world. And that's the reason why US has been trading at a premium compared to the other markets. And when the market recovers, usually US tends to recover faster than, say, Malaysia stocks. So probably, right, if, as I mentioned earlier, it's still too premature to call for a bottom, but if your client is having an aggressive profile, right, and he believes that staying investors is necessary, then probably it's not a bad idea to reassess the situation again. Nakyuddin Razak rightfully pointed out that we don't know deep this downtrend will go and how long it will take to rebound, right? Say you want to stay on the sideline, can you comment the difference between putting capital in Sukuk versus money market at this current economic weather? From a portfolio perspective, the reason why we are actually putting in money market for our managed portfolio is because of the process. Usually when we redeem any portfolio, right, it will take about T+3 to T+6 days, depending on whatever unit trust funds, right? So if we have the money in the form of cash or money market, then probably we can react slightly faster than holding the money in Sukuk, right? So that is from an operational perspective. Of course, when putting in monies in money market, you will also forego probably 1 to 2% of return, right, as compared to putting money in Sukuk. But if we manage to capture some of the market weakness, right, and eventually equity prices go up again when the situation becomes more stable, right, then probably that opportunity cost may also be outweighed by the potential return in equities. What's my comment on China? Questions from Maria. Okay, China this year, right? I think this is also a very interesting question. Why? Because if you look at the recent two-session meeting, uh, they have been rolling out a lot of stimulus package from fiscal and also focusing on areas such as biotech and AI, right? Lesser mentioned on EV because I think they also know that EV is in oversupply situation. I came across a very, very funny statistics in China on the vehicle sales. Vehicle sales for the first 2 months, right, January and February, it was 1.4 million, right? Out of the 1.4 million vehicle sales, 48% is the EV sales, right? 48% is EV sales. If we analyze the number, right, this year, China domestic sales for EV is about 4 million. But do you know how big is the production, annual production for EV in 2025 estimated? It is 10 million. So 10 million production, 4 million demand, right? So the balance 6 million how, right? If they cannot digest, right, the excess inventory in the EV side, they could probably sell it to the rest of the world. Not to US anymore because US is imposing tariff, right? If the EU or US, they gang up together, right? They impose tariff on Chinese goods, then it's very, very hard for them to digest that EV excess production, right? So with that, right, now I think China, the focus, if you look at a slew of stimulus package they've been doing over the past 1 month, right, after the two-session meeting, they've been focusing on domestic consumption, how to spur out the economic activities, right? And also to focus on AI, right? After they see the benefits of emergence of DeepSeek. So if you continue to see, right, like China is going to, continue to subsidize on EV, and so this is not a long-term gain for China, right? For now, they need to focus back on the consumption side of things, right, to increase the demand, right, to increase the inflation numbers as well. Because if you look at China has also entered into a deflation phase, right? Hence, in the recent two-session meeting as well, their target for CPI is at 2%. So it's not easy for China. It's not easy for China. But from a commitment perspective, right, they are now also trying to, give more confidence and assurance to the market that they are very serious to bring China out of the woods again. And fresh from the oven yesterday, right, because of the recent weakness that you see in the market, China SOEs, right, say-no entities, they are also buying ETF and also supporting stocks, giving liquidity to the market, right? So that is also one of the key positives that we see for China. Yanling, tariff led to global recession. How does this model work? Due to slowing global growth, reciprocal tariff. Yes, you are absolutely right. Vicky, Stefan, is there a possibility all the countries involved boycott US? Not possible, maybe, right? Because if you look at the recent development, you see that smaller countries like your Vietnam, Korea, right, even regions like Taiwan, right, they are now trying their best to the US to secure a slot to speak to President Donald Trump, right? So it's very, very hard to also take US out of the equation because US is, the biggest customers, right? That's the reason why they have trade deficit, right, with the rest of the countries. So is there a possibility all the countries involved boycott China? Probably the possibility is higher, but of course, it's also very difficult to take China out of the equation as well because we all know that China has a lot of competitive goods. They are now also trying to be to have more power, right, when it comes to the overall say for the economy, right, from the global perspective. So unfortunately, the situation right now is still very, very fluid, right? probably in future you'll be seeing smaller circles, right? For example, I think China, Japan, and South Korea, they will be coming to Malaysia to also discuss about deals within the semiconductor space. That is also, to somehow counter react some of the policies that are being implemented by the US. So ultimately, I think from Malaysia's perspective, according to Prime Minister Anwar, right, even from ASEAN perspective, right, we will still be maintaining a neutral stance. We'll still be maintaining a neutral stance, trying to make friends, not enemies, with any of the countries. So hopefully that will also address your questions. The slide is not moving. Yes, there's no slides anymore because it's now Q&A. Are there any safe havens? Probably bond, right? Balance funds. Some also mentioned about gold, right? But recently, gold also suffered slight profit taking, not as bad as equities, because a lot traders or speculators, they are also trying to take some of profit off the table and to cover some of the margins position. And that's the reason why you see some sell off in the gold as well. But ultimately, in this environment, like I mentioned earlier, income strategy, balance strategy, dividend strategy are often the most defensive strategy that we could ever ask for. Salient, as recession fear is looming, will any of our PMAT portfolio funds consider US Treasury bills-based fund? Unfortunately, for our PMAT portfolios, it's only for retail clients. Some of the funds that we see available in Malaysia, they are all wholesale funds, so we can't buy wholesale. And also, the timing is also very, very important, right? I also understand that there could be some, short duration funds, long duration funds. So that buying must be tactical. I think ultimately, if you look at our strength, I think from Malaysia perspective, right, not only Phillip Capital, but also other fund houses, our strength is mainly on domestic fixed income, Malaysia fixed income, which is an easier way up. So that will also be a very defensive position to look at. Macy Wong, with the recent drop, will dividend enhanced portfolio benefit from it? Definitely, because like I said earlier, in good markets like last year, dividend enhanced mandate, right? The clients tend to get share price appreciation and dividends. In bear market like this, right, weak market like this, the dividend can also offset some of the capital loss that clients suffer. So overall, despite the broader market weakness, dividend enhanced year to date, right, tend to drop lesser than broader market. China will win or US? I'll leave the time to tell the answer. Brenda Young, what are the pockets of opportunities? Any tactical new managed portfolio for those pockets? Like I said earlier, it's always vital to stay defensive, right? Income balance dividend strategy often stand out during, volatile times like this. Okay. I believe I've answered all the questions from the floor, right? Okay. Is there any final, probably 3 questions that you would like to hear our view? Okay, there's a question from Brenda as well, that the Kwan is not doing well. Will this environment continue to worsen Kwan? I'm not sure about the future, but for the past, Kwan suffered a slight underperformance due to our lesser exposure to tech, right? We used to have higher exposure to the energy sector, and that also explained our underperformance. But I think from a year-to-date perspective, right, our PMAT US fund also didn't drop as much as compared to the S&P 500. Now the Kwan is also holding 10+% cash, right? And that is also helping investors to navigate along the market challenges. So we are not fully invested. Okay. Right. So if there's no any further question, I'd like to take this opportunity to once again thank you for your time, right? And also thank you for your continued support to Phillip Capital Malaysia. This update is brought to you by Phillip Capital, your partner in finance. Thank you.